Well, hello everyone. Welcome in. Thank you for joining us today. My name is Brett Clark, and I'm here with my colleague Sam DeSetti. We're from the InfiniTALKS Coordinated Wealth Council team. Today, we'll be discussing the fundamentals of Roth accounts. So imagine building a retirement account where every dollar of growth is yours, tax-free. No surprise tax bills, no complicated calculations. That's the power of a Roth account. In this presentation, we'll tell you what a Roth account is, compare the differences between a Roth 401k and a Roth IRA, show you some investing strategies with Roth accounts. We will then go into detail on Roth conversions, and then finish up with some questions if you all have some. This presentation is being recorded and will be sent out to everyone who registered. So if you have to drop off for any reason or want to pass this on to someone you know, that will be an option following the presentation. All right, let's get started. So what is a Roth account? A Roth account, whether it's a Roth IRA or Roth 401k, is a retirement account that offers a unique tax advantage, tax-free growth, and tax-free withdrawals. Here's how it works. You contribute money that you've already paid taxes on. That means there's no tax deduction upfront like with a traditional IRA. But the trade-off is powerful. Your investments grow tax-free, and when you take the money out in retirement, you pay zero taxes on those withdrawals, as long as you follow a couple rules that I'll expand on a little later in the presentation. This makes Roth accounts especially valuable if you expect to be in a higher tax bracket later in life, or if you want to maximize long-term compounding without worrying about future tax bills. In short, a Roth account is all about paying taxes now so you can enjoy tax-free income later. It's one of the most effective tools for building wealth over time. There are two types of Roth accounts, a Roth 401k and a Roth IRA, but there are significant differences between the two. A Roth 401k is what you can most likely find with your employer retirement plan, and the Roth IRA is an individually owned retirement plan. I'll start with the differences in contribution limits between the two. For the Roth 401k in 2026, you can contribute up to $24,500 for the year. And if you're 50 years of age or older, you can contribute an additional $8,000. Now, if you're ages 60 to 63, listen up. Your age group can make what they call a super catch-up, which is an additional $3,250 for the year, meaning your total catch-up will be $11,250 for 2026. A Roth IRA has a lower cap. It's just $7,500 for the year and an additional $1,100 catch-up for those 50 or older. Note that you or your spouse must have earned income in order to contribute to a Roth IRA. Now, here's a big difference. A Roth 401k has no income limits. If your employer offers it, you can use it no matter how much you make. A Roth IRA, on the other hand, does have income phase-outs, meaning higher earners may be limited or excluded from contributing. Those phase-outs depend on your tax filing status, so I won't go into all of them, but I will quickly mention that if you file as a single and you make $168,000 or more a year, you can't contribute directly to a Roth IRA. And if you file married filing jointly and make $252,000 or more in the year, you're ineligible to contribute as well. So really keep an eye on those limits. If you do happen to make over those income limits, there is actually a strategy around this called the backdoor Roth contribution, which does allow high income earners to still contribute to a Roth IRA. Due to its complexity, I won't go into detail on that strategy, but please reach out to us after this presentation if you'd like to learn more on that subject. Another key distinction is the employer match. Most employer retirement plans offer a matching contribution up to a certain percentage, and up until recently, that match could only be made with pre-tax dollars. But now employers can put that match into the Roth account. A big notice here that I want you all to know is that if your employer does put the match into your Roth account, that is included in your taxable income for the year. So if your employer tells you that their match can now be put into your Roth 401k, just know if you do choose this option that you will be taxed on the dollars your employer puts in there. There is no employer match with a Roth IRA, which makes sense because this is an account that you set up individually. It's not by your employer. Access to your money in these accounts also works differently. Roth 401ks are subject to your plan's rules, and withdrawals before age 59 and a half may trigger taxes and a 10% penalty. With a Roth IRA, your contributions can be accessed at any time tax-free, which gives you much more flexibility. So let's say you have $10,000 worth of contributions in your Roth IRA and gains of $2,000, so your total account balance is $12,000. You can still access that $10,000 worth of contributions at any time tax-free. The last thing I want to touch on here are those rules for tax-free withdrawals I mentioned in the beginning. For a Roth IRA, the first rule that must be met is the 5-year rule. So your Roth IRA must be open for at least 5 years for you to start taking qualified distributions from the account. And the second is one of the following triggers must occur. Just one of them, not all of these. Either you reach age 59 and a half or older, you become permanently disabled, your beneficiary receives payment due to your death, a first-time home purchase up to $10,000, or you set up a qualified periodic payment plan under the IRS tax law. For a Roth 401k, it's similar. You must meet that same 5-year rule, but the only conditions available for that account are to reach age 59 and a half, you become disabled, or death. If you do meet these rules from these accounts, then all withdrawals, earnings, and contributions are tax and penalty free. So bottom line, Roth accounts are powerful tools, but they serve different purposes. The right choice depends on your income, your employer benefits, and how much flexibility you want with your money. Now, before we get off this topic completely, I do want to make one more important note on something that actually starts this year in 2026. If you are contributing to a 401k plan and you are eligible to make catch-up contributions, so meaning you're 50 years of age or older, and you made over $150,000 in 2025, so this past year, all your catch-up contributions must be made into a Roth account. This applies even if you're only contributing to a pre-tax 401k account. So really make sure that if you fall into this bucket, that your catch-up contributions, so anything over that $24,500 standard limit, is made to your Roth account. If your employer doesn't have a Roth option, unfortunately, you would not be able to make a catch-up contribution in your 401k this year. Another topic we want to hit on is required minimum distributions and withdrawals from Roth accounts. A required minimum distribution, or RMD, as you may hear it, is the minimum amount the IRS mandates you withdraw annually from your retirement accounts once you reach a specific age. These rules exist to ensure that tax-deferred savings are eventually taxed as ordinary income rather than growing indefinitely. In other words, the government just wants to get paid. Currently, the RMD age that you must take money out of your retirement accounts is 73, but the good news is that in 2026, neither the Roth 401k or Roth IRA has RMDs, letting you keep the money in that account and have it continue to grow. There are distribution rules on inherited Roth accounts, however. So if you inherit a Roth IRA as a non-spouse beneficiary, so for example, you inherit it from your parents, let's say that, There are no RMDs from the Roth IRA, but you do have to take the entire balance out of the account by December 31st of the 10th year following the owner's death. For inherited Roth 401ks, it's a little bit more complex. So if the original owner of the 401k had reached their required beginning date to take their RMD, so that age 73, and they had a balance in the pre-tax portion of the same 401k plan, the IRS may require annual RMDs from the entire account, including the Roth portion. The plan rules for the 401k will dictate if this is the case, however, so I would encourage you all to, if you run into this, to reach out to your plan sponsor. The best way to avoid any RMDs from your inherited Roth 401k, though, you just go ahead and roll that account over to a Roth IRA, and you will avoid this more complex scenario. For normal withdrawals from Roth accounts, a common strategy is to delay Roth withdrawals as long as possible. Now, why would this be the case? Because Roth accounts grow tax-free, so the longer you leave them untouched, the more powerful compounding becomes. You can also use Roth withdrawals as tax bracket management. Since the money you pull out doesn't count as taxable income, they're perfect for years when you want to avoid jumping into a higher tax bracket or triggering Medicare surcharges. And also consider legacy planning when it comes to Roth withdrawals. As I explained earlier, Roth IRAs have no required minimum distributions, so you can let the money stay in there and grow and pass them on tax-free to your heirs. We've talked about how to contribute to a Roth account and withdrawals from a Roth account so far. Now let's talk about how we should invest our money with Roth accounts. So when most people think about investing, they focus on what to invest in, right? So stocks, bonds, cash. You can debate U.S. versus international, value versus growth, right? This is what is called asset diversification, and it is a very important principle in investing. But equally important and not really talked about that much is where you hold those investments. This concept is called asset location. Different accounts, so taxable accounts, pre-tax accounts like your traditional IRAs or 401ks, and Roth accounts are all taxed differently. A taxable account will tax investments at capital gains rates. Your pre-tax accounts will tax investments at ordinary income rates, and Roth accounts, as we had mentioned, are tax-free. So placing the right assets in the right accounts can help you not just minimize taxes, but also maximize growth. Roth accounts are unique because they do offer that tax-free growth. So you pay taxes upfront on those contributions. But if you follow the rules, like I mentioned earlier, so you wait until age 59 and a half and you met that 5-year rule, your gains and withdrawals are completely tax-free. So that means every dollar of growth in a Roth account stays in your pocket. There's no capital gains tax. There's no income tax on those withdrawals. This is why Roth accounts are often considered one of the most powerful tools for long-term investing. So how do we take advantage of this? We can put our lower growth or income producing assets like bonds or dividend heavy investments in our taxable or pre-tax accounts. Why? Because these assets don't grow as fast and income in a Roth account doesn't give you as much benefit. And then we can put our higher growth assets like stocks or ETFs or mutual funds in our Roth accounts. The reason is simple. If you expect these investments to appreciate significantly over time, you want that growth to be tax-free, right? So here's where the magic of compounding comes in. Imagine you invest $10,000 in a Roth account in a high growth asset. Over 30 years, that could grow up to $80,000 or more. And every penny of that is yours tax-free. Compare that to a taxable account where you'd owe capital gains taxes on the growth of that investment. Over decades, that difference can add up to tens of thousands of dollars in taxes. So when you're building your portfolio, don't just think about what you're investing in, think about where you're investing. Strategic asset location combines with the tax-free growth of Roth accounts can give you a major advantage over time. Now, Sam, I'll go ahead and pass it over to you to go into Roth conversions.
Appreciate it, Brett. Great conversation and a great introductory just to improve and show the ways that Roth is really beneficial for people. I think it's really important to know also the other side of it, which is the pre-tax. And when it comes to 401ks, when it comes to IRAs, roughly 3/4 of the employee base in our country utilizes pre-tax, right? And that makes sense. Most often, we're working, our families are generating a higher income. It helps us to be able to get that deduction today and start waiting and improve our dollars in our pockets on a day-to-day basis. So that does make sense. Now, that can also leave us kind of with what I like to say, one tool in the toolbox when it comes to retirement. I like to call retirement kind of like building a house. Walking into build a house with just a hammer and some nails is probably not the most efficient way to go about building that house. Just like retirement, right? We want to have tools in the toolbox when it comes to, well, where's my income going to come from? Like Brett said, is it going to come from my IRA, my Roth IRA, my taxable account? Where is it going to come from? So when it comes to what a Roth conversion is, for people that may have built up this pre-tax balance, for people that have been deferring taxes for their working career, we are going to be moving money from a pre-tax account, whether that's an IRA or a 401k, to a Roth account. Now, by making that transaction, that is a taxable event, right? That is affecting your ordinary income for that year. So we will have to pay taxes on that distribution, but like Brett was just talking about in the last slide, the benefits of that is being able to now generate our income, generate our growth in a tax-free way, kind of getting out in front of the RMDs, which we'll touch on in a moment. But really, this is ideally best when you're in a lower tax bracket. Again, like I said, when we're working, we're in a higher tax bracket. That might not make the best sense, but when we're in a lower tax bracket, or if markets have dips and we can utilize a conversion at that point, or before our Social Security or RMDs begin, that's the best ideal time. And we'll get to that in a moment. Really, the two important or ways in which we can start making these, or what really helps utilize these strategies, they're multi-year. So the two biggest benefits is one, let's take control of what our taxes are going to be. Let's not allow the federal government through RMDs to control when we are going to have to make those tax payments. So one, we're going to be able to manage your taxable income over time and reduce any risks or any surprises that may come about when it comes time for RMDs. Secondly, we can be able to spread our conversions and make this a multi-year strategy to make sure, hey, I am dictating which tax bracket I pay up to or into. We're going to help avoid our IRMA taxes, which we're going to get to in a moment as well. But there's a lot of different income thresholds that we don't foresee that are tied to our taxable income. So we have to be very careful. But the end all goal for when we are talking about Roth conversion strategies is really just to reduce our overtime lifetime taxes. All right, so let's get into a little example. We have Tom and Mary here. Tom and Mary, both age 59, and they're making $100,000. They're been healthy savers. They continue to save as long as they're working. They're saving 15% pre-tax. They also are getting a 3% match from their employer. Now, they've been able to save. They built up 401k balances. They have their taxable brokerage account, and they also have started to build some Roth buckets over their working career. Their expenses, as we show, are $2,000, but in retirement, we're going to start, or sorry, their mortgage is $2,000, but there's going to be in retirement spending about $6,000 a month. Now, this strategy that we're showing you is our cash flow planning tool. So this may be familiar to some of you on the call, but the goal of this account or the goal of this example is to help our clients answer the number one question. Are we on track for retirement? So today with Tom and Mary, this is an example that we are successful, but one, let's now control the tax component of Tom and Mary's situation. So on this next slide, after we collect some information about Tom and Mary, we know their expenses. This page here, I know there's a lot of numbers, but what it focuses on is our cash flow coming in from either income sources, Social Security, and then we're also talking about the cash flow going in. I want us to focus just kind of on those two blue columns there. Our system is going to numerically estimate what our RMDs are going to be for our life. And that's the planned distribution cash inflow on the left, like Brett was talking about, when the IRS is going to start forcing us to take distributions. Okay. Now, what we can also foresee is these RMDs, they're being forced for us to be taking. That is taxable income. So that is going to elevate on our right the taxable payments we make as well. Okay. You'll see kind of in the age column on the left, the RMD age for Tom and Mary is age 75. This is one of my very favorite topics over the last couple of years because this RMD has been changing. But if you are born after 1960, your RMD is going to start at age 75. Some of you may remember the RMD age back in 2017 was 70 and a half. I kind of like to say, who came up with the age 70 and a half, right? How do we come up to get a half as the age? Well, in 2017, that was changed to age 72. And in 2023, you may remember, the age was pushed back to age 73, layered starting in 2033, age 75. So there's been a lot of change around this RMD age, and I'll tell you why here on the next screen for us. So for Tom and Mary, this is their taxable income. So in the blue, we can see as they're working, their blue is what is the ordinary income tax they have. Now you can see these colored lines. Those are the marginal tax brackets for our federal system. As you make more money, we're paying a higher tax rate. Those go from 10 to 12, the largest jump to 22%, 24 and beyond. So we can see right here that Tom and Mary are just over that 24% tax rate while they're still working. Now, we had set Tom and Mary to retire at age 65, so that's where you see that steep drop off of income, right? Because now they're retired and no longer having such a great income. Now you see the valley, of course, as well. That age 75, when the RMDs begin, that is one of the reasons why the federal government has started to delay these RMD payments. Essentially, saying, right? We don't. You tell the taxpayer, hey, you don't have to pay any tax, right? We're pushing back this RMD age. Hey, you know what? Maybe keep those dollars in your pockets for a few more years. Well, in reality, what is happening is they're allowing account balances to grow. They're saying, hey, Tom and Mary, yep, continue to save, continue to invest in your market. We'll delay that a few years. Because if we delay that, we'll be able to force you to take more later. And if they can force you to take more later, they might, like in this example, push you into higher tax brackets down the road. Okay, so this is not as glamorous as, oh, hey, we're delaying this so great, I don't have to take as many RMDs. Well, here's the trap that is being laid. So there is a proactive strategy we will consider with Tom and Mary here on the next page. In this example between Tom and Mary, now you see the change, which is in green. So the blue is still their taxable income, and the green is what I would suggest Tom and Mary to do in terms of the Roth conversion strategy. Okay, by paying up to a very certain amount in tax, up to that 22% level, you're going to be able to take control of, one, again, the timing of when you pay your RMDs and you pay your taxes, and two, how much you're going to pay in tax. So for this example, their adjusted income would be up to $111,000. They're back over that higher income. They're going to be converting in that small green number, $253,000. But again, up to a very specific point, because what we can see or foresee down the road for Tom and Mary is after age 75, their income is going to be, or their taxes are going to be higher than they've ever had in their working career when they are no longer generating W-2 income. So this is a very important case for Tom and Mary to consider. Now, what you see on the far right, that kind of lighter purple color, is the reduction in taxes paid. We're being able to get out in front of the future tax payments, spread that out over a working or a longer period of time when they're not working and in that valley, as we call it, and making sure that, and you see on the right, that is almost a $500,000 difference, $438,000 of assets that they're able to continue to grow and not have to pay tax on at a later date. Now, this is all very glamorous. We talk about, hey, we're able to make a lot of money, pay a lot of less taxes federally. There are common mistakes that people can make when it comes to Roth conversions. One is overlooking your IRMA. Okay, that is your income-related monthly adjustment. So the Medicare Part B premiums that you pay out of your Social Security check are directly tied to what your taxable income is. So when we make those conversions, like we just saw, and our income has continued to be elevated, that is directly tied to how much that premium, that Part B premium is in our Social Security. So the IRMA tax is a surcharge that applies when you exceed certain limits. I will show you that on the next slide here, but it matters because certain triggers can occur if we decide to make really large Roth contribution strategies. So it might help for people who may already be looking at Roth conversions to either lower the tax bracket they pay up to or try to stream it out over a longer period so they don't trigger one of these higher premium amounts related to their income. Secondarily, people often forget to make sure they pay their quarterly estimate payments. So when we make Roth conversions, again, our income is much more elevated than what our likely last year's tax payment was. So if you're now in a higher income, you may have to pay your quarterly estimates. What those usually are is IRS says you can pay either 100% of your last year's tax payment, 90% of your current year's tax payment, or 110% of your current year's tax payment if you are over, or if you make over $150,000. So as Brett and I work with individuals, we like to bring in a CPA if you have one, or a tax accountant, to make sure that we are reassuring our numbers and making sure if we are converting a large amount, let's make sure we know the tax impact and make the payment if necessary. As I said on this next slide, I want to show you visually some of these triggers that happen when it comes to your Medicare premiums, because I think it's very, very important to understand, right? Because Roth conversions can help us get out a lot of federal taxes. Now, but what we see here for Tom and Mary is up to that 24% level, they're not triggering those colored brackets or those triggering events tied to their IRMA tax. You can see, though, the purple, if they did not make a Roth conversion, they would be triggering as they go up that purple line. So by the time they're age 81, they will be paying, each of them, $240 more each month for the rest of their lifetime, because those RMDs are forcing them into higher tax brackets. So for Tom and Mary, it doesn't just help their federal taxes. It doesn't just help them be able to start growing tax-free dollars. It is also helping them stay under these triggering tax Medicare premiums by getting out in front of it earlier down the road.
Thanks, Sam. That was great. Great detail there. Just a quick, want to just do a quick recap real quick before we jump into questions. Roth accounts, very powerful tool, right? This tax-free growth, not paying any taxes on the gains if you follow those couple rules I had mentioned, can be very powerful. But as we said, Roth accounts are for specific purposes, right? It is, it can be advantageous to spread that kind of tax burden out between different accounts. So you have that diversification, kind of when you need the money and when you don't, and when you pay taxes and when you don't, right? So Roth accounts can be extremely powerful. They're great tools. Roth conversions are a really powerful strategy that we employ quite a bit with people. So yeah, I mean, thank you so much for joining. Really appreciate it. And yeah, if you guys have any questions, we'd be happy to answer them.
Hello, can you hear me now?
Yes, we can.
Yep.
Yes, I do have a question. So I noticed that there's the salary limit of $252,000, correct? That you cannot put into a Roth anymore?
Directly, yes.
So
if you file married filing jointly, yes.
Okay, so let's say, for example, like you have a base salary that's less than that, but you get annual bonuses that you don't know what those will be. Do you recommend waiting until like your W-2s fall and then you make the full $15,000 between you and your wife contribution for the prior year? Or I guess, what happens if you put into it over the year and then all of a sudden right at the end you get a bonus that pushes you over that income? What is there a penalty, or what do you kind of do there? Does
So
that make sense?
yes, it does. Yeah. So yeah, you do have, so yeah, if you don't make any contributions and you wait, you do have until, Sam, correct me if I'm wrong, I think it's April 1st, right, to actually contribute for the prior year. So you have up until April 1st of this year to contribute for 2025 if you want to go ahead and wait. If you do contribute throughout the year and then you realize your income will be over that limit, you can take money out to avoid the penalty. So that's something you could do. But yeah, it's a tough situation when you don't know exactly what your W-2 income will be until the end of the year. If you're contributing on like a monthly basis or something, we would just say, yeah, be cautious of that, but there are options around it.
Okay, thank you.
Mm-hmm.
All right, guys. Well, thank you very much for your time. If that's the questions that we all have for today, we really appreciate you taking some time here during your lunch break on this Wednesday, and we hope you have a great 2026.
Thank you, everyone.